always, is request for bill introductions. Yes, we are an exempt committee and we still take requests. Seeing none, however, we'll move on to our first item of business for the day, and that is a hearing on Senate Bill 35. And I would turn to the revisor's office for an overview on that, please.
Thank you, Mr. Chairman. Senate Bill 35 would discontinue the state property tax levies, which are cumulative of 1.5 mils for the Kansas Educational Building Fund and the State Institutions Building Fund. And this would occur after tax year 2025, so after the current tax year. And the bill would also provide financing from the State General Fund beginning in July 1st of 2026. Under Section 1 of the bill, this would discontinue the state tax levy of the 1 mil on all taxable tangible property in the state for the use and benefit of the state institutions of higher education. Currently, monies received from this levy are credited to the Kansas Educational Building Fund. Correspondingly, Section 2 would provide that on July 1 of 2026, or as soon as monies are available, $56 million would be transferred from the State General Fund to the Kansas Educational Building Fund. And then on July 1 of 2027 and each year thereafter, the amount of the transfer would be equal to the immediately preceding year, plus the percentage equal to the average percentage change in statewide taxable valuation of all property for the preceding 10 years. So essentially an escalator clause that would increase it. Under Section 3, this would discontinue after tax year 2025, the state tax levy of the 0.5 mil on taxable tangible property for the use and benefit of state institutions caring for certain persons. Currently, the monies received from this fund are credited to the State Institutions Building Fund. Then there'd be a corresponding transfer on July 1, 2026, and then thereafter of $25 million with starting on July 1, 2027, an increase equal to the immediately preceding year plus 2% of $25 million. And then lastly, Section 5 is kind of a technical cleanup dealing with accounting procedures related to the current tax levies. And with that, I'd be happy to stand for any questions.
Thank you. Committee, are there any questions? Seeing none, Adam, I guess and you might not be able to answer this, but I noticed the kind of the growth factor, if you want to call it that, is different on the two. Do you know the difference why one kind of uses that 10-year average and the other is just a flat 2%?
You know, there were originally the first one, it was a 2% of 50 million. I believe it was either floor amendment or a committee amendment that changed it for the one but not the other. And besides that, I don't know.
Okay. And the 2 mil levies after tax year 25, so will they be on this year's tax statements for property tax? It's going to be another 7 months before we see those, but is this considered tax year 25?
Yes, it should be this calendar year.
Okay.
Yes.
Okay, so they would still see that this year, but then after this year, it would be discontinued.
It would be on the December and the correspond, is it May or April payment? Yeah, so but then after starting next year in 26, they would no longer be assessed on property tax.
Okay. Seeing no other questions, thank you very much, Adam. Unless Kathleen's really itching to get up here. I think the fiscal note kind of speaks for itself, but unless anybody would like to, or if anybody had any questions on the fiscal note, if not, we'll give you a break today on this one. Okay, we'll now turn to our proponent testimony on Senate Bill 35 and welcome first to committee John Donnelly.
Thank you, Mr. Chairman. I just ran up 2 flights of stairs, so can Kathleen come up and say something real quick? So, my apologies if I'm a little bit winded here, but thank you for hearing this bill, Senate Bill 35. I'm John Donnelly here on behalf of Kansas Farm Bureau. You've basically heard this testimony, so I'm going to be brief. I'm actually here more to just be here for questions if there are any. Kansas Farm Bureau has been supportive of broad-based tax relief. We testified on the earlier bill reducing the 20 mills down to 1.5 mills, and obviously this does the same thing. This bill does have a larger fiscal impact because the residential exemption is not included in the 1.5 mills. So essentially that, whatever, we're at 75,000 now, that is actually would be reduced on that on the residential property as well, which will provide more property tax relief for residential properties. But with that said, we actually think this is a good measure. We appreciate the legislature leading on this issue. You've all heard that property taxes and property tax reduction is one of the key issues that you hear about when you're running for re-election or election, and we think this is a proper approach. This is broad-based. This affects everyone, albeit I'd love to see more. Everyone would love to see more, but we also know you have the fiscal constraints that you're working with. So with that, we appreciate your leadership, and we hope that local units of government will follow your lead and do the same. So with that, I'll stand for questions and catch my breath. Again, I apologize.
Well, we're not going to let you sit down. We'll take a question. Are there any questions, committee? Seeing none, thank you for your testimony. Next, I'd like to welcome Aaron Popelka. Yep, there he is. Welcome to committee.
Thank you, Mr. Chairman, members of the committee. Aaron Popelka with the Kansas Livestock Association. I will be brief because you've heard this on a different bill, kind of same message. Our policy supports broad-based property tax relief that applies to all classes of real property, including agriculture. We think that cutting the statewide mill levy is the best way to do it, whether it's the state building funds in this bill or the statewide school mill levy. And so we'd just like to share our support and thank you for hearing this measure, and happy to stand for questions.
Thank you. Committee, are there any questions? One thing I do want to point out, probably the biggest difference between, because 1.5 mils is 1.5 mils to the taxpayer. At the state level, as the previous conferee had mentioned, it does not take into account, this one does not take into account that residential exemption that we've increased. But another big difference is this is kind of a one-time cut. The 20 mils that we had in House Bill 2011 continued to, as valuations grew, it would continue to kind of trim down that mill levy. This might be something that we need to take a look at after we get this done. This is kind of a one-time property tax relief. It's permanent. The 1.5 mils would never come back on. But I guess this isn't really a question for you, more of a comment, but just, do you have one that you would prefer over the other? Should we work? Because we have House Bill 2011 out of committee. It's on GO, but it's under the line. Does your organization have a preference on which way we go on this?
I think if you're asking which would deliver more relief, I think you're correct. In House Bill 2011 does have that adjustment factor to the 20 mils. So I think if you're saying which one, we might prefer that approach because there's the ability to get additional relief as we go forward on a revenue neutral approach, if you will. But certainly if you wanted to combine the two concepts, that might be a good approach as well.
That's exactly what I was thinking. So, all right, seeing no further questions, thank you for your testimony. We have several other written testimonies. Was there anyone else wishing to appear before the committee as a proponent? Seeing none, we do have written only neutral testimony, and I see him sitting there, so I might call him out. Would you be willing to step up, Dr. Blake Flanders, and maybe just provide us some perspective from the Regents, maybe summarize your testimony if you don't mind?
Sure. Thank you, Chair Smith and members of the committee. We've relied on this funding stream for a number of years. It's been a stable funding stream for maintenance for the facilities. We have over 1,000 buildings, and it really takes, if you think of your home or any facility that you're trying to maintain, and we've seen state buildings that weren't maintained, it takes about 2% a year, 2 to 4% a year of the total cost of that. And so then each year that graduates in terms of the amount of funding that it takes to maintain that building, if you're going to keep that building online. This doesn't represent the totality of what's needed. So we have a maintenance assessment at the universities, and we're growing into that 2% a year. So they put in their own resources. There's some from the Education Building Fund, and then there's some from the Facility Renewal Fund that's used to maintain those facilities. And then we've also seen some facilities get too far down the road in terms of maintenance, and that the decline in a facility is not linear. So if that maintenance isn't done early on, that curve doesn't continue to add at the same incremental pace every year. It actually starts to spike. And if you think about a window in your home, if it begins to leak and you don't fix that for a couple, 2, 3 years, I've personally had that, then you're going to be replacing sheetrock and things inside the wall. And the same thing is true with university facilities in terms of maintenance. We've used some of our other facility dollars to actually tear down facilities, to shrink our footprint. And then if a facility's too far gone, you may not want to invest in that facility because the cost of actually renewing it is more than it's actually worth. And so you've all dealt with that with other state buildings before, not just ours at the universities. We do appreciate the Senate and their efforts to replace the funds. We're neutral because we just need a stable funding source, and we recognize the need to lower property taxes, and we're not, we don't really have a position on where it comes from.
And that was the main thing I was curious about, was those growth factors. You know, we were very cognizant in House Bill 2011 to make sure that the legislative intent was clear to backfill that. It looks like the growth factors are attempting to do that same thing, and I just wanted to make sure that what was in place here was acceptable by the Board of Regents.
It is, and again, we thank the Senate for that. I would tell you on growth, we have really worked hard to address. We have about a $1.2 billion deferred maintenance liability, and so we're really all hands on deck to reduce that. But the past few years, inflation has just killed us. So you're working very hard, and then you can be losing ground just on that inflation factor. As that building increases in value and the cost of those repairs increase in value, you can see what that does to your real-time purchasing power.
Thank you, and thank you for letting me put you on the spot. Is there anybody else that had a question for Dr. Flanders? See none. Thank you again. Show no opponents. Is there anyone wishing to appear as an opponent on Senate Bill 35? Seeing none, we'll go ahead and close the hearing and open up our next hearing, which is House Bill 2276. And I'd turn to the reviser for an overview, please.
Thank you, Mr. Chairman. House Bill 2276 would establish a tax credit for eligible small businesses that purchase qualified news organization advertising. And this would apply for tax years 2026 through 2029. There would be a 50% income tax credit for the first year and a 20% credit for each subsequent year for qualifying taxpayers with qualified local news organization advertising expenditures. The credit maximum is $5,000 for the first year and $2,500 for each subsequent year. The credit would be a carry forward credit for up to 10 years following the year that the tax credit was earned. Under the bill, eligible taxpayers would be limited to entities that employ less than 50 full-time employees in Kansas. Taxpayers would be required to submit a certification signed by the local news organization that such taxpayer purchased qualified local news organization advertising, and that a false certification would be subject to a penalty of not less than $5,000 and not more than $10,000 for each such false certification. And with that, I'd be happy to stand for any questions.
Okay, committee, are there any questions? Seems pretty straightforward. Thank you, Adam. We'll now turn to Department of Revenue for an overview on the fiscal note.
Mr. Chairman and members of the committee, Kathleen Smith with the Department of Revenue. We are estimating that House Bill 2276 would decrease state general fund revenues by $3.3 million in fiscal year 27 and $2.3 million in fiscal year 28. To come up with that estimate, we did look at the U.S. Census Bureau and found that there are around 19,600 small businesses that could participate in this tax credit. And if 10% of those eligible businesses utilized the tax credit to the max of $5,000 in the first year and $2,500 in the next year, that the bill would be expected to generate around $9.8 million in tax credits in tax year 26 and $4.9 million in 27, 28, and 29. We did make an assumption that only 1/3 of the tax credit amount would be allowed against the tax liability in that year. So that brought down the fiscal note to the 3.3 and 2.3.
Thank you. Representative Sawyer.
Thank you, Mr. Chairman. So 10% seems kind of low to me. Did you have some basis for?
We did not.
Okay. So if just 20% took it, the fiscal doubles, right?
That is correct.
Okay. All right, thank you.
Further questions? Representative Wolf.
Thank you, Mr. Chairman. My question is going to be what it was before. We give tax credits. How do we know when they take these off on their taxes that's actually how they use them? Do we have a way to follow up and know?
If we were to ever audit the businesses, we would be able to check at that point that the expenditures were actually used for media expenses or the expenses that they had. Yes.
Do we have enough staff to audit anything very regularly?
Not regularly.
Okay,
Probably.
appreciate that. Thank you.
Seeing no further questions, thank you, Kathleen. We'll now open up our proponent section testimony and welcome first to committee Darren Keeter. Welcome to committee.
Thank you, Chairman Smith, members of the committee. My name is Darren Keeter. I'm from Wichita, Kansas. I was born in Topeka, 1965. I'm a third-generation contractor, small business in the state, United States Marine Corps veteran. I was asked to come to the committee today as a small business owner to discuss House Bill 2276 and how it may have a positive impact on my business and other small businesses in the state. I'm hoping to explain and maybe even get bold enough to offer some advice about how this bill will benefit my businesses and others in the state. Small businesses like mine, as I've evolved from a family business to a sole ownership of my own business, which is in the roofing industry, and I do siding replacements, home exteriors. Well, I didn't go to college and understand marketing, and I've had to learn now to become a marketing expert. And I remember the days of spending money in the penny power and how it's evolved. And Google has taken over the world of marketing, and we struggle. I pay attention to things like cost per lead. How do we obtain these leads? Broadcast marketing is so important to us, as so many other small businesses. And I believe House Bill 2276 can generate more involvement from small businesses on television to pursue our customers that create revenue, help us hire employees, create tax revenue, and beyond. Trying to understand the Google game as a small business owner, from Mays, Kansas, where I live now. It's difficult. They're always moving the goalposts on me. I don't have the funds as a small business to get to the top of the list on the first page. The amount of money it takes to get there is insurmountable. I rely on broadcast advertising to get my face out there for awareness, people that are in need of our services. And this tax bill will enable us, and I think more people, to utilize the broadcast networks to reach the consumers. I think the broadcast media I love. I'm on TV all the time, and we stay right in front of our customers' minds and their thoughts as they're about to spend money, as they're going to do a home improvement or anything of the sort. I believe Kansas is losing out in the Google marketing world because the money doesn't stay in the state. I can tell the committee that the $5,000 tax credit to me, only myself, is a very small part of my budget. I would reinvest that $5,000 right back into it immediately. I spend almost $300,000 a year in a small business of 14 employees to compete, and I would have never have dreamt it all these years ago. I couldn't fathom. I've had to become a marketing expert. I'm not, but I try, and I have good people on my side. I know the state is in a shortfall. I've done my reading before I came. And not only am I here to support this bill, but I'm so proud as a Kansan to be here in this Capitol building today. I can't tell you, never would have dreamt it. It's quite amazing. But I support this bill. I believe this local brand of marketing is so important to the state, and to get other people that are not using it to utilize it. We have to use it. We have to be out there, and not just a sponsored ad on a Google page that costs an insurmountable amount of money. You know, my cost per lead, again, I would like my cost per lead. That's not jobs sold. This is what it cost me to get the phone to ring. I may not even sell this job, but right now I'm at $350 per phone call. Well, I'm a little sticky with my sales team. That was expensive. I'd like to get it to $150. And I believe the broadcast media in this bill 2276 could help. If I could spend more and utilize more to get our advertising out there to the general consumer, whether you're a roofer like myself, outside exterior contractor, or a homeowner, I believe this bill will be beneficial. And I believe the money, that $5,000 per credit, thinking of the shortfall, would come back, I would assume, more than double in increased revenue, material spending, hiring, right down the line. So again, I'm here in full support of this bill. I've been excited to learn and read about it. I'm more excited to be here. But since I have the floor, now's my time. I've watched this on TV for years. This is not a filibuster, I promise. But it's amazing. I'm pinching myself, so bear with me. While I have the floor, the industry I've chosen to be in since childhood and beyond is roofing. And I want to take this time to say, I know this is not the committee for this, but you all might be on other committees, but I believe this state is missing, grossly missing, and we are not protecting our residents and consumers in this industry that is the most unregulated industry, I believe, that I've ever known. of legalized theft, which is the insurance roof repair world. I believe the state is missing so much revenue when I look at the shortfall that could be gained from what goes on in my industry. If you knew, it's terrible for the homeowner. So much missed revenue, deductibles being eaten. There's no rules against all these canvassers. When the storm hits, they're out knocking on doors before the hail's even melted. And it's a scam, and nobody's doing anything about it. So I wanted to take this moment while I'm on the floor to say, if somebody's on another committee, call me. It should be discussed because it's out of control. I wanted to say I went 2 weeks ago to Kansas City and also Springfield to listen to one speaker from our industry. He's from Florida, very accomplished, very impressive. It changed my life, actually. He spoke of what they did in Florida to protect the homeowners from the savagery and the stress of so many roofers knocking on your door. Who do you hire? How do you handle it? I don't want to pay my deductible. All these things, and it's outrageous. He said, Florida passed a bill called HB 76. So I looked it up. Florida, I love this. They made it so that if you're going to go knock on doors after a hailstorm, that if you knock on the door, you have to commit to doing a full-blown estimate on the spot, which takes a day, half a day or a day. That'll stop these contractors or people they hire to knock doors and help create revenue for the state by stopping this, because I can explain, but I won't now. But I just believe the state is missing. This industry is out of control. There's no regulations. The building code departments do not check. We buy the permits and that's it. But I would love to see some regulation and protect homeowners from the door knockers so that people can make their own fair assessment and call legitimate contractors, because my favorite thing to say is real roofers will never knock on your door. And as I explained to one elderly customer last year, she said, "Oh, I thought they were an eagle." And I said, "No, if you look up, they're all circling, but a lot of them are buzzards." And it's true. So I love my state. I appreciate this opportunity. I'm hoping my testimony does some good. But I believe this House bill can be covered up through revenue, more purchase materials, labor, everything that goes into it. I appreciate your time, and I'm proud to be here. Thank you.
Thank you for your testimony. Are you willing to take a few questions if we have them? Just in case. Committee, are there any questions? Representative Butler.
Thanks for your professional presentation there and statements.
That has nothing to do with what I wrote, sir. I totally.
Was it AI? I mean, did you pull that on? No, just kidding.
That came from in here.
You could tell. My question is, what do you feel that this will not only enhance the opportunities for small businesses, but also then those news organizations such as newspapers, small news organizations out there that are trying to keep their head above water? Do you think that will increase by you getting this? Will it then in turn put that money back into those small businesses that are doing the advertising itself? So,
I truly believe so. Unfortunately, when I learned that Kansas Broadcasting, the local stations, who I have great relationships with, every single one, there's 4 majors in Wichita, and that broadcasting goes all over western Kansas. But they have the least amount of employees now than ever. In any state in the nation, it's down. The employment. Justin Murray, he's my COO. He's huge help to me. You just mentioned, we went into a studio to take a tour before we shot a commercial. There's nobody in there. The cubicles were all empty. Very few people. It's not robust. Like, I've been doing this so long now that I remember it was just a churn mill of activity of people. Google has shut it down. And I believe, and I truly believe, that television marketing is the way to go for me and what I do. But I don't go knock doors. I want my branded name, and I believe the broadcast will do that. It's hard to believe what you see on Google sometimes, especially if it's sponsored. I have a very good commercial. It says, I wake up early. I come in early to make sure that every job's done and the customer's happy and satisfied and there's no sleight of hand. And the broadcast media is so down, but I hope I've answered your question.
Representative Corbett?
Thank you, Chairman. This may be to you or whoever. Does this bill just limit you to local TV advertising, or is it more, or is it just advertising your business? You know what I'm saying?
Might turn to the reviser, but it looks like the bill says a qualified local news organization advertising is, looks like it would be local news organization, which would be a newspaper or also a broadcast radio or television station.
Just for my comment on this, I think it shouldn't be limited to local, because a lot of time your customers are far more further out than that for some businesses. But it's a good concept. I just think if we work it, I'd probably have an amendment, but it's a good shot. Thank you.
Thank you.
Okay. Representative Kessler?
Thank you, Mr. Chair. Thank you for being here today and testifying. I just was kind of trying to wrap my head around here that although I like the concept, I think actually it's a pretty unique way of looking at things. I don't mind that a bit, but when I come to it, you're looking at a tax credit that's going to be like 1.5% of your advertising budget. I mean, it's kind of hard for me to kind of figure how significant is that tax credit going to be to your business when it's 1.5% of your budget. And then the following year, it's less than 1% of your budget.
Yes, sir. I'm not here because it's about me. It's easy for me with my budget, and I'm fortunate to have a sizable business that I've mentioned with my advertising budget. I mean, also, my revenue is between 7 and 8 million a year. I have percentages I try to keep everything in. My cost per lead's out of control, but I don't know how to stop. This is small potatoes to me, and that's why I say I'll reinvest that right back to gain, $5,000 to me if I wanted to do really important broadcast network. I mean, I could probably get 4 commercials out of that 5,000. Prime time, 10 o'clock, or a big time show or a sporting event. I will spend that money on that. They just offered me a fabulous package for the March Madness for $35,000. I declined it because I don't think we're going to make it very far. I want to be on there. It's great when we make it to the Final Four, but you're right. It's small to me, but I'm not here just about me. It's the really small businesses, the knitting stores, the others that's big money, and they can get a lot of ground and advertising out of that. They'll sell the material, they'll sell services, goods, and I believe that will come back as tax revenue.
Any further questions? Representative Howerton?
Sorry, the representative to my left just got me thinking. So is Google a local? Because they can, even Facebook can market locally by zip codes. So is that defined in this bill? Would that be considered local? Sorry.
I might turn to the reviser on that one because
Yeah.
I think it's ultimately going to need to be spelled out, because the people that are asking to qualify for this credit might think that, Facebook marketing on my local little area might qualify.
It can be local. It can be very specific, so.
Under page 2, the definition of a local news organization, probably the one thing that would limit such an entity, as you discussed, would they have to meet the membership requirements of the Kansas Press Association or the Kansas Broadcasters Association. So I don't anticipate that would be the case.
I think that would be something we should consider if we work this bill. Just, that's really effective marketing and advertising as well.
Representative Corbett?
I also agree with her comments. You shouldn't tell a business person, he should know where his market is. You shouldn't tell him where you want your money spent. He knows where the market, or she knows where to chase the market. It may not just be Channel 27 or 41 or whatever. But if the bill was worked, you'd want a little flexibility, I think, if you're going to work it.
Representative
Just a
Howerton?
follow-up, is there even sales tax on that? On Facebook or Google? Do you pay sales tax?
I can't
Maybe
hear
that's
the
why it's
question.
limited?
I can't hear the question.
Do
Representative.
you pay sales tax on Google advertising? Do you do Google advertising?
Do I do Google advertising?
Yes.
Absolutely.
Do you pay sales tax on that?
I'm sure I do. I got to check. Justin, do I pay sales tax on? I believe yes, I do.
Okay, thank you.
I mean, I don't even think is there sales tax on like newspaper advertising?
My Google advertiser's in Austin, Texas.
Okay.
Never met him. It's always a Zoom call, but.
Okay. Okay. Representative Sanders?
Thank you, Mr. Chair. I can speak to broadcast advertising, and there is no tax on broadcast advertising. I don't know about Google.
Okay. Yes, any further questions, committee? Seeing none, thank you very much for your time and welcome to the Capitol. I hope you've enjoyed your experience. You did an excellent job if this is your first time testifying, so.
Thank you very much.
Thank you. Members, we have a lot of written testimony, but I don't want to miss yes, Representative Hoheisel.
Thank you, Mr. Chairman. I was informed there is another proponent that wants to speak to this real quick if I.
Okay, yes, yeah, if there's anyone I do not want to miss, so if you want to speak to the bill, please step forward. Do we have written testimony?
You do?
Okay.
Yeah.
Thank you.
I missed the boat somewhere on
No,
that. We got it, but I don't,
that's okay.
we did our part of it. Anyway, hey, I'm happy to be here too, as happy as I was 3 weeks ago. So I'll come back anytime. Chairman Smith and committee members, my name is Jeff Cott. I'm a second generation newspaper publisher in Kansas. I own and operate Derby Media Resources and the Derby Weekly Informer. It's a weekly print and daily online news service that we offer in Sedgwick County. And we've been going strong for 25 years. I am also the board president for the Kansas Press Association this year. And I'm here on behalf of KPA, and more importantly, I'm here on behalf of the many, many small businesses in Sedgwick County and Kansas that this bill will really enhance. Among the many jobs of a small town publisher are developing advertisers, learning businesses, learning the people, learning their problems, learning their challenges. And if we're doing our job right, we're doing that. Having done that for 25 years, I have to say that in the last 5 to 10 years, I've seen more challenges and problems with very, very small businesses than I've seen ever. There's a lot of reasons for that. I mean, a number of reasons, of which we'll kind of try to address some of them, but can't address them all. For audiences today are fragmented, and it has a lot to do with what we were just talking about, with the technology and communication resources that are available now. What is that doing? It's fragmenting the audiences even more, where it means an advertiser has to spend more money to get the same results. And this is a challenge for struggling businesses that, need to bring consumers in their doors and are having difficulty with the challenges in dealing with that. Another issue, I think, there are businesses I run into twice a month that are still recovering from COVID. I had a conversation with a family business owner here about 2 or 3 weeks ago, a long-time business, been around for a long, long time. And she told me that she thinks in 2025, they'll get back to pre-COVID revenues. And that's to think about the 5 years or more that she spent just getting back to pre-COVID numbers. National and regional marketing companies do come in. They do extract dollars, whether it's Google or Facebook or whatever. But the difference is they're not reinvesting in that community like a local business will. And enhancing a local business through a bill like this and helping them be able to bring more customers in the long run, those people want to reinvest in their schools and their communities. And giving them that opportunity with this bill can help them do that. There are seriously, in looking at the last 25 years and the last 5 to 10, I've seen more frequency of closing businesses than I've seen in the previous years. This bill gives them an opportunity to increase their budgets, and it allows them to invest in the most important person they have to have, which is that local person. That person that lives there, that person that goes to school there, that person that participates in the community, they have to be able to get that person first before anybody else. Most small businesses understand that the more eyes you have on your message, the more prospects and the more sales you can make. It's a numbers game in many respects. This bill should allow them to be able to possibly expand into other areas that they can't just do it all now. It's really not a matter of will, but a matter of resources for them. The ability to capture the resources to move forward and do the things they need to do to stay alive and continue to serve the markets. And I think we all agree that a business that doesn't market at all for over a period of years is probably going to be fatal at some point. This bill will help them grow. It really, really will. We believe it'll help them grow. It'll allow them to increase their own community involvement, increase jobs, potential expansion, and offer that other financial support to other people in the community. One big thing it might do, might be give them a big reason to fight on and tackle the challenges that they continue to have, not only in just bringing in customers, but other things. We know these people will support the community. We don't know if the regional and national companies will really support them in the end. That's one of the key elements. Most all small businesses understand that the majority of consumers trust their community news source. And it's the best place for them to find their customers, and they know that. And therefore, there is a strong desire to want to reach out to them. They want to invest, and the ability to do that is just getting harder and harder all the time. With this bill, you're not only are you supporting local businesses in this bill, but you can join in with them, and you can help in keeping local community journalism alive for the community and for the businesses. We ask basically, it's simple, if you can help support Kansas businesses in your communities as well by supporting this bill. Thank you for your time and your attention, and I can stand for any questions if I can help.
Thank you. Committee, do we have any questions? Seeing none, thank you again for your testimony. Is there anyone else wishing to appear as an opponent or a proponent on House Bill 2276? Seeing none, I'll let the committee know again, we do have multiple written proponents, and we do have one opponent testimony, appears to be written only. Is there anyone wishing to appear as an opponent? Any neutral? Seeing none, we'll go ahead and close the hearing on House Bill 2276. Committee, we do have a little bit of time left today. I'd like to take action on HCR 5011 and House Bill 2098. We'll start off with the resolution, and I'll turn to the reviser for a reminder on what that one is.
Thank you, Mr. Chairman. House Concurrent Resolution 5011 would amend Section 1 of Article 11 of the Kansas Constitution relating to property taxation. Under the resolution, would propose that the valuation of real property used for residential purposes would be determined based on the lesser of either the fair market value or the average fair market value of the residential portion. The legislator would be able to establish the number of years to determine the average fair market value and further provide for valuation adjustments by law for new construction or improvements, changes in property use, property that is listed as escaped or omitted property, and changes to the description of the land. The proposed amendment would be submitted to the electors at the November of 2025 general election.
Okay, thank you, Adam. Representative Hoheisel?
Thank you, Mr. Chair. Just quick question to clarify. You said November of 25? Was that? Okay, sorry. I was thinking in my head 26 for some reason, but okay. Thank you, Mr. Chairman.
Representative Corbett.
This will be probably for the reviser or someone. Is there anything in this 5011 that would help any business people with property?
Not as it stands now. I do have an amendment, though, for commercial property. Is that what you're asking, commercial properties?
And do you have any kind of an idea how much it might reduce or what it actually does, like on a $100,000 house, or what comes out of this if we pass this? What kind of is there a tax break there for homeowners?
Any type of valuation limit just mathematically will not result in a tax increase because the value of the property as it's held lower when the local governments adopt their budget, it's a simple equation of dividing their total valuation by the valuation of the property. So if you lower all properties, but then I just about said personal property, but your own property is lowered, but if all of the properties are lowered, your ratio stays the same. So it really doesn't result in tax relief. So you can't say that by restricting the value, it's going to result in a certain dollar amount of tax relief unless the local governments don't increase their budgets.
But if it's a constitutional amendment, would business property tax have to be worded into it now?
Yes. Yeah, as it sits right now, it only applies to residential property. Yeah. Representative Long.
Thank you, Mr. Chairman. If this passes constitutionally, it would require a trailer bill that would come along later. Could you walk us through what would be contained in that trailer bill? Because it'll coincide with this and make it a little easier for me to understand, perhaps. There'll be several issues that need to be addressed, right?
Yes, there are. Let me see if that is live. It is not. It was just read in this morning. It's House Bill 2394. We're kind of working the bill the resolution right now. I can email that stuff out to everyone, kind of what my intent was. I know when we had the hearing, I kind of went over that and tried to explain what the parameters were as far as proposing 6 years, what we would do with certain situations on certain properties when they would transfer for sale. If you had a large remodel, there's a lot of different situations that would have to account for. Okay. Any further quick questions for the reviser? Okay, seeing none. Tanner, I might have you go ahead and pull up that presentation right now. I had Department of Revenue Property Valuation Division provide a rather in-depth study, pulling some sample properties, because I'm curious. I wanted to see what this will actually do. They were able to pull up 15 years worth of data. I did residential properties and commercial properties, and I built some graphs based on their information that they gave me, and I just wanted to run through those right quick. If you can't see them on the screen very well, they are on the S drive. They are public. The S drive If you go to today's meeting, they are under the folder HCR 5011, and they're titled Residential Property Impact and Commercial Property Impact. They're PDF files, but I just wanted to take everybody through what these looked like in real-world application if we would have had this in place 15 years ago. So this is the first property. This is a residential property. This is just a regular property. There haven't been any improvements done. This is the low range for value. As you can see, it starts out just under $40,000 in 2010. Goes along, there's several lines there. That large, the thicker blue line is the current, or that's the actual fair market value for each year. The solid line that's a little bit thinner is the HCR 5011. That is the 6-year average that you see there. I went ahead and put in a dashed line to mirror what the Senate's version of the 3% cap is, just so you can see the differences between fair market value and then the two proposals that we have before us. So you can see it really, both the proposed resolutions kind of have a smoothing effect, but you will notice they both kind of follow the same line up until about 2020, and then when the housing market really increases and the valuations start increasing, you can see the impact. The dashed line, the 3% cap remains perfectly flat. That's a fixed rate. The 6-year rolling average will allow a gradual increase. It looks like it lags behind about 2 years, but it does allow a little bit faster realization of that fair market value, so you don't see some of the regressivity that you would under a fixed cap. The second property here is the same. It's a kind of a mid-range property. Its value starts out at $125,000. Again, there's no improvements on this property. It's just kind of a standard home. Again, you see kind of the same factor there, the smoothing of the two different proposed amendments. There's a little bit of an increase there in 15 and 16 and 17. That's where that lags behind, and that's where both the fixed rate cap and the smoothing, the averaging system, helps smooth out some of those peaks. This property actually, I'm not sure exactly what the story is on it, but it held pretty flat from 16 to 20. Actually looks like it went down a little bit, but both the 3% cap and the 6-year average caught up with the fair market value in 2020. And then as the market increased, you could see the result of that. The third property here is, again, a residential property in the higher range that saw a significant increase and significant demand over the last 15 years. You can see a little bit of difference there in how the 6-year average versus the 3% cap would have worked in comparison to the fair market value. We have several situations. Those are all kind of standard properties. The next few situations, I had Property Valuation Division pull some situations where you had a home that existed, it was demolished. You had some homes that were remodeled or added on to. We're going to go over some of those special scenarios. This is a really small, lower valued home that was ultimately demolished in 2022. And you can see the impact of how that system would bring that down to the actual fair market value upon a significant drop. This one is a vacant property that had a new house built on it. I want to draw your attention to there's a right above the years 22 and 23. I apologize, they're kind of small. I threw this together like an hour before the meeting, so I didn't I would have made it larger if I would have known it was going to be that small on the TV. But there's a series of little dots there right above the 22 and 23 years. That is the 150%. To Representative Long's question, in that trailer bill, what I had proposed is if there was a improvement on a property that was greater than 150%, it would trigger the actual taxable value to be at 100% of fair market value. Otherwise, it would take 6 years for that average to kind of pull into effect. So those little dots there represent what would have been a 50% increase in the value, total value of the property. So as you can see, building the new home on there looked like it's about a $225,000 home. The taxable value actually jumped up to the actual fair market value in 2023, and then perhaps they might have finished up doing some more construction. The value increased again pretty significantly in 2024, but it did not exceed the 50% cap from the prior year. So the averaging and the 3% cap kind of started deviating in that year. The sixth example here, this is an older home that was torn down and then they built a brand new home. Again, you can see how from years 2013 to 2018, that both the average and the cap kind of held that value down a little bit, created a more consistent, stable taxable value for the homeowner. When the home was torn down in 2019, the taxable value went down to probably whatever the actual land value was worth. And then in 2022, once construction was complete, the taxable value went back up to the fair market value right around $250,000, and then the average began phasing in from there. The seventh property here, this was just a remodel. They didn't actually tear the home down. There was an existing property, and you can see these graphs really were interesting, and I'll notice this again on the commercial properties. From 2010 to 2019, you know, people were complaining about property taxes, but the overall values actually were fairly stable, fairly consistent in a lot of these examples. I'm not going to say every property across the state looked like this, but on average, the valuation increases and decreases were actually fairly predictable and stable. In this example, I'm assuming the house wasn't torn down, but maybe they had, I don't know if this was some exterior work or interior, I don't know the details on this specific property, but there must have been a little bit of demolition to go along with the remodel here, so that it had a little bit of a dip there in 2020. Again, that little dotted line above there, that is a 50% increase over the 2020 value. So you can see that fair market value, once they were finished with their renovation, actually exceeded that, which means that new taxable value would jump up immediately to the new fair market value. In both of these scenarios that are being proposed, both the House and the Senate resolutions are trying to account for situations like this. So after 2021, the average would begin kicking in at that point. I think this is the last one on residential property. This is a home that didn't have any remodeling done. It was just an addition to the property, so you didn't see a drop in the value as in the previous example. So again, fairly stable values along until 2020 and 2021 when these renovations were complete. Since it did not exceed the four or the little dots in 2022 and 2023 are clear up there at the $300,000 level, that would have represented a 50% increase in this property. Where the renovations didn't, or the addition didn't hit that limit, the simple average system remains, and we just plug those new numbers into the average, and you can see the impact that it has on the taxable value. Now, originally when I drafted the resolution, I didn't include commercial property because I didn't think there was usually that much variance and volatility until I got this data from Department of Revenue, and it showed a lot different story. You can see kind of similar to the residential property from 2010 up until past, in this example, 2020, pretty stable. Not a lot of drastic up and down, very, very flat. Breakfast time? Yeah. But as you can see, in 2022, values, even on commercial property, started increasing significantly. This one's interesting. I think this one shows an interesting example of how the average valuation in this example actually helps control that or stabilize that valuation growth even more than the 3% average, because it's a 6-year average. So in 2021 and 22, when it's starting to increase a little bit, it's still not more than 3%, so it wasn't capped. Under a 6-year average, it really smooths out even that small increase to where the 6-year average is less than what is seen with the 3% fixed cap. However, with the large increase, and I don't believe there was any improvements to this property. I don't know the details on the commercial properties. We didn't identify if there was any additions or renovations on the real estate. But that spike really starts taking into account in 2024. The dotted lines up there again indicate what would have been a 50% increase, and it did not hit that, so we just continue with the average. This is a commercial property that's kind of in the lower range value. I've got, I think, 3 or 4 low range, 3 or 4 mid range, and then some upper range, just to give a good sample of what happens in some of these situations. This is another property, this very similar. Saw a little bit of up and down there in 2018 to 2020, and then we saw some increase. Again, it did not hit that 50% threshold, so the value did not increase. Just goes along with the averaging system. This is one that saw a little bit more steady impact. Commercial property number 3. Again, it just shows you the different taxable value as those rates. This one has a little bit more volatility than some of the others did, a little more up and down, but you do get to see the impact of the averaging system there. This is the last low range value. Again, I don't know the situation on these properties, if there was some improvements done, but this one sees a much larger increase. Looks like 2013 they must have added on or done something, but not to exceed that 50% range. So you really get to see on this the smoothing effect of the averaging system, or the potential for a very large disparity. If this was under the 3% cap, all of the improvements that happened from 2013 to 2024, by 2024, if we adopt a 3% cap, their taxable value is only $125,000, where the actual fair market value is approaching about $235,000. So they're paying less than half of their actual fair market value. These are some mid-range properties. Again, just showing some of the similar effects on these. And as I said, you've got a copy of all this in the S drive if you want to review it later. This is one that they had some improvements done, I think. They destroyed some property and then they rebuilt. This one did exceed that 50% threshold in 2017, just barely. So that's when that new average started from there and continued up until 2024. Same situation here. They made a major improvement on the property and exceeded that average. Okay, these are some upper range commercial properties from $500,000 to $1 million. Chart doesn't look a lot different than some of the others, but you just gives you an idea of the effect of the impact of both of these resolutions. I don't know what happened in this property here. It had almost $1 million valuation and lost about 40%. So they might have torn a building down, had a fire or something, and kind of restructured their property. I should have gotten some more details from PVD if they could have told me on this, but I was really trying to get a variety of different situations here to plug in the parameters on how both of these resolutions would work in real time, because a lot of times we make decisions, we pass laws, but we don't have a crystal ball to look into the future to see how it would impact it. this was essentially looking into a crystal ball from 15 years ago to see what would be happening should these have been adopted 15 years ago. And that's a third commercial property, and I think that's it. But now that I've thoroughly put everybody to sleep, oh, we still have a few people awake. I think at this time, I will go ahead and have Adam pass out the amendment that I had prepared. Okay, it looks like everybody has a copy of this. Adam, would you kind of explain what the amendment does?
Sure, thank you, Mr. Chairman. The amendment would add, in addition to essentially residential real property, excuse me, it would add also real property used for commercial industrial purposes, which is a defined subclass under the Kansas Constitution, and also tangible personal property classified as mobile homes, which is a defined subclass under the Kansas Constitution, as subject to the ability to value property essentially according to the fair market value and the averaging provision of the Constitution, and then later statutory approval and requirements.
Thank you. And again, to Representative Corbett's question, this does include commercial properties. And if you remember from the hearing, mobile homes that are classified as personal property are set up on a depreciation schedule, but it's not a straight line depreciation. It is based off of the value, so we needed to include those in this amendment as well. So that is my amendment, and I'd look for a second if I had one. Second from Representative Hoheisel. Representative Corbett, did you have a question?
This passes in 25. When would be the first time someone could appeal, or how would they appeal their taxes between then and whenever? You know what I'm saying? So if this, if you had a problem in 25 or 26, how would this kick into your appealing your property tax?
I think the appeals process would work exactly the same because you are appealing your current year fair market value. And under this policy, the current fair market value would still be calculated. It's just when it came to the calculating your taxes, they would use this modified average to calculate your taxes. So the appeals process should work the exact same.
That would be the solid blue.
Yes. Representative Shu.
Thank you, Mr. Chair. I like this amendment, or I like the concurrent resolution as it is with just residential. I'm actually pretty opposed to adding in all these other classes in there. For me, when I'm knocking doors, the primary people that need property tax relief are seniors on fixed incomes who can't handle the huge spikes that we've seen since the pandemic. Corporations have literally doubled their profits in the last 10 years. They can afford, for the most part, they've made profits on that, and so increased property tax on them is bearable. But on seniors on fixed incomes, they're literally not bearable. So even younger people like me who own houses, our mortgages are in escrow, so our property taxes just kind of come out of that. We don't really feel it, and we'll eventually probably sell our houses to realize the profit out of it. This doesn't really make any sense, just kind of from an ideological perspective for me, so I would oppose this amendment.
Representative Francis?
I would just say that not all businesses are created equally. And in rural America, on Main Street, we are being killed by property taxes on our commercial properties. It's 30%. So, I think we need to make sure that we understand that different things are important in different areas, and I support the motion.
Representative Stogstill and then Corbett.
Thank you, Mr. Chair. I'd echo what Representative Shue had to say. My district is overwhelmingly concerned with residential property taxes, and I could not support the amendment. I think we need to focus on residential property tax relief, and to me, this waters that down, so I'd be voting no on this amendment. Thank you.
Representative Corbett.
I know I knock on business doors and I knock on everybody else's doors. And when somebody tells me that their property taxes are $60,000 and they make pancakes and breakfast, you know how many pancakes you got to make for $60,000 to pay your frickin' property tax? I strongly support this amendment, and they need a break too.
Representative Butler.
I go out and knock on doors out in rural Kansas, in the Morris County area and Junction City area, and those doors and those small businesses, which are the backbone of our state. We have to have them. They've all said, look, we've got to do something for our businesses, and so I would support this one.
Any further discussion? Seeing none, I'll go ahead and close on my amendment. All those in favor, please say aye. Aye. Opposed, no? No. Anyone wishing their vote recorded? The ayes appeared to have it. The ayes do have it. Any recorded votes? Seeing none, the motion carries. We are back on the resolution. Any further discussion? Representative Long.
Thank you, Mr. Chairman. I do find your graphs fascinating to look at. I will, when I look at them on the left side, I see it doesn't matter which graph, but you've got market values on the left side of the graph. In the case of commercial property, you would take that times 22% to get an assessed value, correct?
25%.
25%. So where we see it on your graph where it's talking about actual market value, you'll see a gap between the 6-year average and the 3% cap. You'll see it, whatever that gap is. But if you take it times the 25% and get the assessed value, that gap becomes even closer, right? In other words, the assessed value might be a $50,000, or excuse me, the market value might be a $50,000 gap, but assessed value, it might only be 10 or 20.
Right, it would still be proportionate, but the actual dollar amount would be less.
Right.
Yes.
But then you take the assessed value times the mill levy and, yeah. Okay, thank you.
Okay. Any further discussion, committee? Representative Shue.
Thank you, Mr. Chair. I guess I'm just, the HCR itself and the constitutional amendment itself does not have a fiscal note because it's just a question. It is the trailer bill that has a fiscal note, but this, I mean, I guess I'm just confused because if we go to the trailer bill, this passes, and then we go to the trailer bill, and then all of a sudden we see that maybe this amendment that we just added on quadrupled or whatever the fiscal note. Is there any ability to adjust at that point, or would we just kind of be bound by this? And then does that ultimately mean less residential property tax relief if adding these extra things in kind of cause things to go out of balance? Just kind of a thought.
Yeah, and I might put Eddie on the spot a little bit because The interesting impact of this is once it's implemented, the 6-year average, the way it phases in, it doesn't immediately go to that 6-year average because I was wanting to avoid a fiscal note. The Senate Resolution 1603, I think you had actually created a fiscal note for that, or I had seen one. There's one that exists because that one actually, there's a Senate amendment that takes it back to 2022 values, and there was a fiscal note on that. That's one of the big differences. I'll try to stall here while he looks for that, but yeah, if you have.
Thank you, Mr. Chair. The fiscal impact of 1603, if approved by the voters, that's the kind of the concurrent resolutions that are constitutional amendments. When they're with the legislature, they never actually have fiscal notes because they're dependent upon further voter approval, which isn't assumed. But if it is approved by the voters, that would, of course, impact the uniform levy or the fixed rate levies, the 20 mils and the 1.5 mils. For all of the local levies, the levies would be readjusted. So the impact to the state on the 20 mil side of that is 165.2 million in the first year, and it rises to 265.7 million by 2030. Of course, the 1.5 mil is quite a bit smaller. It's 15.7 million in the first year and rises to 25.2 million by 2030. And obviously this could have a fiscal impact as well, depending upon the further implementation of the bill by legislation, but that would be prescribed by that legislation.
Did that help answer the question? I think that's a good question, and it's important to understand that just because there's not a fiscal note doesn't mean there won't be any fiscal impact to it. So that's a very pertinent question. Yeah. Further discussion, committee. Yes, Representative Clayton.
Thank you, Mr. Chair. Just to put this out there for the committee, I know that some statements were made earlier in the point of discussion of this amendment that that rural businesses were somehow Main Street. We have Main Street in Johnson County too, and want to make that very clear here. I will likely be supporting this bill, although with some misgivings because I did not support the amendment, but I do think that the potential property tax relief that it provides for our residential folks will be immeasurable, especially in Northeast Johnson County. That said, I don't know. I sincerely hope that the businesses who will be benefiting immensely from this will, at least do something like increasing the wages that they pay their workers so that they're more able to pay the other heightened taxes that they have to deal with.
Well, and I do want to go back to some of my original comments to trail off of what Representative Clayton just said. When we hold the valuation down, and your local governments continue to adopt even if they adopted the exact same budget, revenue neutral, didn't raise a penny, your mill levy is still going to go up to offset that valuation. So, I try to really be careful when I talk about tax relief with these valuation limits because it does not actually result in tax relief. It results as you restrict that valuation, your valuation goes down, so your mill levy has to go up to equal the same amount of dollars. Local governments don't pass mill levies. They don't set the mill levy. They pass their budget, and then they back in, they calculate what the mill levy needs to be. Now, a good fiscally sensitive local government official is going to be very aware of what it does to the mill levy and try to keep that reduced. But if we restrict the valuation under these and they don't cut their budget, that's the only way that they could keep their mill levy the same. They're going to have to increase their mill levy. And we're asking, are we going to ask the local governments to cut their budgets as we're cutting their tax base? If they're not cutting their budgets now when appraisals are increasing their tax base, their valuation, total valuation is going through the roof, no pun intended. I think it's a little hard to expect that they're going to cut their budgets with a smaller tax base. So, Representative Sawyer and then Francis.
Yeah, and that's part of the problem with the amendment that went on there. By putting that amendment on there, that again puts more pressure on local governments to increase that mill levy a little higher. So the residential property owners aren't going to get as much of a benefit from this bill than by adding the commercial. It's going to be less benefit for the residential.
Yeah, and I would agree. And there's also other property classes, depending on what your county or your taxing jurisdiction is made up of. We can't all be a coffee county and have a nuclear power plant in our backyard. Some of us would not probably like that, but you know, the balance of your valuation really impacts how that would shift and benefit certain classes of property. Representative Francis.
But I would say also that there's a benefit to both local government and to our business owners and our homeowners when there's greater predictability in what the valuations are doing. You know, most years there's not a lot of ups and downs, but I know some former county commissioners would be reluctant when there was a large increase in valuation to decrease the mill levy because they know how hard it is to raise it later. When we have a more even revenue stream or valuation stream, they're able to plan better. Homeowners in their home are able to plan better, and I think we'll have better public policy made.
Yeah, and that's really the premise behind this averaging system is it kind of buffers that and smooths things out to make it more consistent and predictable. Representative Turner.
Thank you, Mr. Chair. Just to clarify, when Eddie gave the fiscal note, is the fiscal note based just on the 20 mills and the 1.5 because those are set in statute? Because those local taxing entities ultimately, as was just discussed, this isn't a direct impact on taxes except for these two because they are set in statute. Is that fair?
Yeah, that is correct, with the exception of if any capped mill levies could also be impacted by it. Also, within the school finance formula, there's the capital outlay mill levy is subject to a specific cap, so that could also be impacted for school districts. But generally speaking, the typical local government mill levy is not subject to that cap and would fluctuate according to valuations just based upon the budget of the local government.
Thank you. And I just wanted to go back because people were talking about knocking doors. This doesn't decrease taxes. This is only the base on which those local entities can choose to apply whatever tax level they choose to apply. All right. Thank you.
Any further discussion? Representative Sawyer.
Yeah, the biggest benefit to me all along of this resolution is the smoothing out. You get rid of those big increases, the big spikes. So in spite of the amendment going on, which like I said will provide less benefit to residential than the underlying resolution would have, I'm still going to support the resolution.
Seeing no further comments or discussion, Representative Hoheisel for a motion.
Thank you, Mr. Chair. I move that we pass out HCR 5011 favorably as amended.
Do we have a second? Representative Butler. All those in favor, please say aye. Opposed, no. Motion appears to carry. The ayes do have it. Motion carries. Okay, committee, thank you for your work. We do have one last bill I'd like to take a look at really quick. It's House Bill 2098. And Mr. Sievers, would you give us a brief summary?
Thank you, Mr. Chairman. House Bill 98 would provide a sales tax exemption for purchases made by not-for-profit corporation exempt from income tax that operates a theater in the state of Kansas that provides essentially 5 qualifications, which would be the creation and production of novel works for concerts or productions, the employment of full-time theater staff, a board of directors, number 4, the dedication to providing strong educational commitments to the community in which such theater is located, and number 5, the commitment to providing ongoing live theater as an art form using available local resources.
Thank you. Committee, any questions? Not the first time we've seen this bill, so except for the new members. I want to respect that. Any questions for the reviser? Seeing none, any discussion? Representative Sanders?
Mr. Chairman, I would like to move that the committee pass HB 2098 out favorably.
Okay, do we have a second? Second from Representative Stogstill. Any further discussion? Seeing none, all those in favor of the motion by Representative Sanders, say aye. Opposed, no? The ayes appear to have it. The ayes do have it. Motion carries. All right, thank you for your attention, committee. Sorry to run this so close to 5 o'clock, but no meeting tomorrow. Have a nice weekend.